Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, October 16th, 2023. We'll start with our executive summary from our leadoff morning note this morning. As always, if you want to get the analysis supporting these conclusions, as well as what to do about it in your portfolio, you need to be a subscriber of 42 Macro. So we'll start with number one. Bond yields are back on the rise after investors spent the weekend digesting last week's deluge of sticky inflation data out of the U.S. economy. The quick twitch reaction to rush into treasuries as a safe haven is already proven to be a bad idea, with the 10-year nominal and real treasury yield up 16 basis points and 9 basis points respectively from their respective lows last week. Number two, last week we unpacked how the September CPI and PPI data unequivocally demonstrated a renewed inflation impulse that is in line with two of our long-held qualitative research views. Number one, inflation would bottom at a level that is inconsistent with the Fed's 2% inflation target prior to recession. And number two, a recession would be required for the Fed to at least temporarily achieve its price stability mandate. And then lastly, number three, Friday's University of Michigan consumer inflation expectations were supportive of our sticky inflation view as well. The median response to the one-year survey increased 60 basis points to 3.8%, which is the highest since May. And the median response to the 5 to 10-year survey increased 20 basis points to 3%, which is also the highest since May. Sticky inflation expectations among consumers will keep upward pressure on wages and downward pressure on corporate profits. That is a key dynamic to monitor throughout Q3 earnings season. Transitioning to my Bloomberg here, we'll go through our cross-asset performance here, starting with U.S. equity sectors. So S&P up 0.5% week over week, being led higher by energy up 4.5%, utilities up 3.6%, and real estate up 2.3%. So this makes a lot of sense in the context of the macro, the movement in the macro drivers we saw last week. Investors rushing into treasuries as a safe haven, gold, energy, etc. In terms of equity factors, pretty limited dispersion amongst the equity factors. S&P up 0.5% week over week. The one laggard here is the high beta minus 1.1%. So investors are definitely interpreting the move lower in treasury yields as an incremental sign of recession fears, however they may unfold in the context of the geopolitical headwinds. In terms of the geographic performance, S&P, as I mentioned, up 0.5%. Geographies are being led higher week over week by Brazil, up 3%. We also have Canada up 1.3% as well. Lagging, you have Universe or EZU, that's Eurozone minus 1.4%, and Australia minus 1.2%. In terms of fixed income performance, the core ag up 1% week over week, being led higher by long duration plays like TLT up 3.3%, and investment grade credit up 1.4%. In terms of currency performance, dollar up 0.6%, Swiss franc up 0.8%, so a little bit of a safe haven bid in the currency market as well. You're seeing Australian dollar down 1.3% as a laggard there. Commodities up 3.9% week over week. In terms of the DBC, that broad basket, commodities being led higher by energy up 6.5%, precious metals up 5.4%. So definitely seeing that safe haven bid there. And then lastly, in terms of crypto, you're now getting a big move here this morning and obviously week over week in crypto. Bitcoin's up 4.8% week over week. Crypto being led higher by Solana, up 7.9% week over week, but all crypto are up on a week over week basis. Lastly, transitioning to my Lombo dashboard here, we're getting a view of the trading ranges across some of these key global macro markets. Call out gold here is now overbought in terms of the Lombo signal there. It's got neutral short-term, medium-term price momentum, so it's definitely in kind of a wait-and-see type moment. If we start to see develop some bullish medium-term price momentum in gold, that's likely to come on the heels of some bullish medium-term price momentum in treasury markets, but we don't believe that we are at that particular point in the cycle for that to transpire. So maybe certainly if you've been playing alongside of gold, it's a good spot to be thinking about taking some risk off the table there. And then lastly, with ag, also getting an overbought signal in ag as well. So just wanted to flag that for you this morning. So we'll wrap it up there. Darius Dale presenting our macro minute for Monday, October 16th, 2023. Everyone have a best of luck out there today. Have a great week. We'll catch you back here tomorrow. Cheers.